So hi everyone, welcome to this session where we're going to talk about how to build the foundations for growing your SaaS startup to a really large company. My name is Mikael Johnsson. I'm a co-founder and general partner of Ox. We're a specialist VC firm looking to back Europe's most promising B2B SaaS companies at the scale-up stage. That means we invest $5 to $10 million in initial checks in companies that have proven product market fit and are looking to accelerate their commercial and product development activities. Personally, I'm in my 21st year of investing in fast-growing tech businesses. The majority of that time I've spent in B2B SaaS. I've had the fortune to be part of taking companies all the way to successful IPOs and trade sale exit, but I've also had the less pleasant experience of seeing companies fail despite checking all the boxes on paper. So this presentation today is an attempt to summarize perhaps the biggest lesson I've learned, and hopefully by sharing that with some of you out there, building the next generation of exciting companies, you will not have to make the same mistakes. So to cut to the chase, what is the major lesson learned? Well, the one major sin I and we as a firm see time and time again is companies trying to scale their marketing and sales efforts by brute force too early in their commercial development. For every successful SaaS company, there comes a time when it's time to step on the gas and double down aggressively on marketing and sales. But if you do that without first establishing a strong platform, that will inevitably lead to poor decisions, wasted money, missed opportunities, unnecessary dilutions for you as founders, and usually the inability to fulfill the company's long-term mission. So to avoid this pitfall, it's helpful to think about your company's growth journey in three distinct phases: product market fit, go-to-market fit, and growth in the mold. This model comes from Mark Roberge, who was the first CMO of HubSpot, and it's really a helpful guide in terms of thinking of what to focus on at the different stages. And going back again to the cardinal sin, we see way too many companies trying to skip and jump over the intermediate step here of go-to-market fit, and they are very rarely successful in doing so. Sure, there's always companies that come flying out of the gates and will have their go-to-market nailed from the get-go. I'm sure you're all familiar with companies in this current market like Hopin, etc. But the vast majority of B2B SaaS companies trying to skip the go-to-market fit stage is a recipe for disaster. So my goal for today is to share with you some recommendations, ideas for how to approach this challenge. But first, anyone listening here today will know about product market fit, and you will have heard it and you will have discussed it at length. But the problem with product market fit as a concept is that it's nebulous and it's fuzzy. People have different definitions when most are not measurable and therefore not very helpful. At Ox, we firmly believe that for a SaaS company, retention really is the best evidence that you built a product that satisfies the need of a market and therefore you have product market fit. Exactly what retention number to target will vary depending on your go-to-market motion and your annual contract value size. But at the enterprise level, for instance, you typically have higher retention than in the SME market. But aggregate level, there is relatively broad agreement that a 90% plus annual customer retention is a sign that you're ready to step up your investment in marketing and sales. If you want to be a bit more sophisticated about that, you can have a look at annual revenue retention instead of customer retention, where we would argue that 100% plus net revenue retention really is the sign of good product market fit. However, no matter what percentage rate you're trying to hit, or whether you're looking at customer or revenue retention, retention is a lagging metric. You only know what your retention is when you know, and once you have all the facts. So if you're a relatively early stage startup selling 12-month contracts, you'll need to wait 12 months until you know what your retention is. Ideally, you would obviously want to know a lot earlier about that in order to not lose out on momentum and scaling too late, which could be equally as value destroying as scaling too early. So the key here is to look at cohorts of customers and figure out what are the leading indicators that will get you to the 90% plus customer retention or 100% plus net revenue retention that you're looking to get to. Unfortunately, these indicators will differ for each company. So there's no fixed recipe to just follow, but usually they will involve different ways of understanding the breadth and depth of penetration of your product within your customer base. And that can include things such as how many product features or modules is the customer using? How many users of your product are there within the organization, whether in absolute terms or in terms of penetration? How many different teams or departments have you penetrated? What are the actions, quantitative or qualitative, that customers may take with your product, which signal that we stay with it, etc. Defining these indicators is an extensive and iterative process. We could spend lots of time discussing it here today, but unfortunately, that will be the topic of another discussion. So you are at the point where you've proven there's a market for your product. You have an initial base of enthusiastic customers who stay with you and buy more of your product. You've also figured out what are some of the leading indicators of high retention, and you decided that now is the time to start investing aggressively in marketing sales. But you've also heard the warning about trying to scale with brute force and the risks that comes with that. So what should you do next? Well, unsurprisingly, our recommendation is to build for go-to-market fit, which is the intermediate step in the three-step model that I showed earlier. And where product market fit is all about proving there are customers out there who value your product, go-to-market fit is all about proving you can identify these customers, that you can reach them, you can sell to them, you can onboard them, and you can upsell them, all in an economically viable fashion that provides strong return on the monetary and people investments applied. And just only once you have proven this out, you are ready to really double down on your marketing and sales investments. And just to avoid any confusion here, let me be very clear that inserting this intermediate step of go-to-market fit in your growth journey does not mean you should lower your long-term ambitions. Quite the contrary. The entire purpose of building for go-to-market fit is to ensure you've built a proper growth engine that won't break down once you hit escape velocity, and that you will be able to go even faster when the numbers get bigger. So I'm by no means suggesting that you should slow down and be less ambitious. What I'm saying is you need to invest proactively in building a scalable go-to-market machine. So just like we think about product market fit in terms of customer and revenue retention, we think about go-to-market fit in terms of return on investment, where this is expressed as customer acquisition cost and lifetime value. And I'm sure that all of you know that the ultimate metric that people apply to determine ROI in SaaS is the LTV to CAC ratio. And if you're at the point where you've proven your ability to go to at least some sort of scale with an LTV to CAC ratio over 3 or 4, you are, according to common wisdom, probably in a good position to start investing aggressively in marketing and sales. Now, those of you out there who are SaaS metrics aficionados or simply may have a keen eye for math, you know that the LTV metric is not unproblematic, especially in the early stages of a company's development. So an alternative and somewhat simpler way to think about go-to-market fit is if you can recoup your investment in customer acquisition within a relatively short period of time, usually 12 to 24 months. And this, of course, is the infamous CAC payback ratio. CAC payback has the benefit of being simpler and less subject to practical challenge than LTV to CAC. So we will often recommend focusing on that metric, which also has the added benefit of being a leading indicator rather than a lagging indicator. The one word of caution here, though, is that CAC payback only makes sense as a leading indicator if your customer and revenue retention metrics remain sufficiently attractive. It obviously makes no sense to have a 12-month CAC payback if you're churning out your customers after 11 months on average. So defining and building a scalable go-to-market machine is not something that is best done at scale, but rather with extreme focus and a series of controlled experiments and iteration. Think about this as analogous to a minimum viable product when you launch a product into the market. What is the minimum viable go-to-market test that you can launch and then iterate from On the right-hand side of this slide, I've included Insight Partners' periodic table of sales and operating metrics. And they provide a good idea of what different variables you can twist and turn and move when searching for your unique recipe. These tend to work a little bit like whack-a-moles in the sense that they will co-vary, and changes to one variable may very well implicitly impact another one. So you need very precise measurement, testing, and iteration to keep tab on what's working here and what's not. So from this, it follows that, unfortunately, which is so often the case, every company will be different, and the unique market circumstances will decide what is the right recipe for you. However, that being said, there are a number of general rules of thumbs, or recommendations, if you like, that I would like to share with you in order to help you get to that elusive go-to-market fit. The first of these is double down on retention. Everything you do at this stage presumes you can maintain attractive customer and revenue retention metrics. The beauty of SaaS, of course, is the compounding nature of revenues, but that only works with strong customer and revenue retention. Also, it is obviously a lot less costly to retain and upsell an existing customer who's familiar with the benefits of your product than landing a new customer. So if you have high net revenue retention, you will be able to grow a lot faster with less investment than if you don't. The charts here on the left and the right-hand side, they show the same new client acquisition, only on the left-hand side with a 95% net revenue retention, and on the right-hand side with 105% net revenue retention. And the impact there is obvious for everyone to see. So driving customer and net revenue retention higher, that is the first key to successful scaling. And unless you're exclusively selling into the SME market, we would suggest you should target a net recurring revenue retention here of at least 120% or even better. The second piece of advice is about focus. Fast scaling SaaS companies generally have a very clear focus in their go-to-market. This comes in many different shapes and can be centered around customer size, industry, geography, business function or department, a partner ecosystem, a technology stack, whatever have you, or honestly, any combination of these. Generally though, the sharper your focus, the better. It is much more effective to build a 10% market share in an extremely well-defined niche segment, and then you add the next such niche and the next and the next, rather than desperately fighting for a 1% share in an ill-defined market segment, and then trying to scale that to 10% by essentially shouting louder than everyone else. For anyone who's read Jeffrey Moore's Crossing the Chasm, this will be very familiar advice. And if you have not read that book and incorporated those lessons, I would strongly recommend you in doing so. Another key part in focus is nailing down your buyer persona. These will obviously, again, differ depending on what product you're selling and into what size of company and into which industry. But fast scaling B2B SaaS companies generally have no more than 3 different buyer personas they're selling to. If they proliferate beyond that, it is difficult to maintain sufficient focus. And it's doubtful, honestly, that the product solves someone's problem in a fundamentally different way. It is also becomes much more difficult to cut through the noise to catch your target's interests in the first place. The third piece of advice is to invest in scalable demand generation. And that may sound like an absolute no-brainer. However, we see a lot of companies who have built to a decent amount of ARR, sometimes in the $10 to $20 million, by selling on a combination of local networks, charm, and honestly hustle. And unfortunately, that is not very easily scalable. So product companies with strong go-to-market fit, they will have invested in a scalable and predictable top of funnel demand generation process. Doesn't matter if that is product-led, if it's direct or indirect, if it is inbound or outbound, driven by inside or outside sales, or any combination of those. The key point is that the company knows where do leads come from, what is the cost for obtaining a lead, what is the process for refining that lead, and how many of those leads do eventually become customers. Having established these funnel conversion metrics it will allow a company to much more effectively ramp and fine-tune the marketing spend to drive forward growth. It also has the added benefit of putting you in the good books with your board and investors, since it allows you to forecast forward bookings with much higher accuracy. One major challenge in building such a scalable demand generation is that the tactics that work in a particular geography, a vertical or use case, may not work for another one, meaning you have to tweak it across segments and geographies. This is especially true if you have at least some element of outbound or channel activity as your go-to-market motion. And it goes without saying then that having nailed this in a large segment or geography trumps proving a smaller one. So the fourth and final piece of advice relates to sales specialization and customer success. Scaling a sales organization is very much an exercise in focus. People who specialize generally perform better than people who split their focus, dabbling in many different things. In line with this, companies that have found their go-to-market fit will usually have adopted specialization within their sales organization, separating between sales development reps, whose responsibility is mainly to refine marketing qualified leads and sales qualified leads, and the account executives, whose responsibility is to close business. These companies will also generally have implemented a separation between new account acquisition and upsells on the existing customer base, where SDRs and account execs are focused on new accounts and a customer success team is focused on upselling. There are other types of specialization as well that apply, and the common ones would be enterprise versus SME, direct versus indirect, or specialization within certain verticals, for instance. Perhaps the greatest benefit of sales specialization is that it becomes so much easier to recruit the right people to the right roles. In general, this means that risk of failed recruitment goes down, as does the time it takes to onboard and ramp sales resources to full productivity. So, in order to summarize, how do you nail SaaS at scale? Well, start by thinking about your growth journey into these different phases. Build first for product market fit, then to go market fit, then you can double down on your growth and your moat. The cardinal sin that we see way too many times and way too often is trying to skip this second phase and go directly from phase 1 to phase 3. Proving out go-to-market fit is critical, and it's ultimately about ROI on marketing and sales investment. Every company's recipe for achieving go-to-market fit will be different. However, there are general recommendations that apply, and I've just named them for you in terms of doubling down on retention, staying laser focused, invest in scalable demand generation, and specialize your sales organization as early as you can. So with that was the end of my presentation. I would be very happy to hear any feedback or questions